Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. We've just had the federal government hand down its 2020 budget, the delayed May budget. We thought we'd just share with you some of our thoughts on the budget and the implications for financial markets as we head into the back end of this year as well as through 2021. I've just got a couple of charts to show this. The first two charts here you can see the one on the left is reflecting now the absolute size of the budget deficit that we've seen post the budget being handed down. The deficit now is ticking just a little over 5% of GDP, so the deficit close to $220 billion in dollar terms. So the largest deficit that we've seen since the Second World War, and as you can see there, certainly more significant than what it was through the 2008 GFC crisis. But from our point of view, when we think about that in the context, yes, it's significant, yes, it's large, but we think it's entirely appropriate given the current economic backdrop that not only Australia is facing into, but equally the rest of the world. The second chart there is just highlighting, how did bond markets react post the budget being handed down on the 8th of October. And you can see there that bond yields have actually fallen. And again, we think that that's reflective of financial markets really understanding that fiscal spend is required alongside what we've seen from central banks around the world in order to get economic activity moving again, in order to get people back into the workforce. So from our point of view, we think that the move in bond yields is entirely appropriate. Normally you would expect bond yields with that size of deficit, as I said, to sell off, so yields to move higher. We think financial markets have been very sensible in the way that, as I said, they've thought about the need for additional fiscal spend. The second chart there, page, just shows, where does Australia sit relative to the rest of the world? And again, when you're looking at the size of the deficit, you think that obviously Australia doesn't, compare favourably. But when you absolutely look at the level of deficits, net debt to GDP of Australia compared to, other developed market economies as well as many other emerging market economies, you can see it roughly around about 40%. Australia's debt to GDP ratio is at the low end, as I said, to many other economies around the world. So in our view, it does afford the federal government the opportunity, if it needs to increase that level of debt higher as we move through the next couple of years. The other important element to note around that is that Australia has been able to maintain its AAA credit rating. And this is particularly important in the context of being able to go to markets, as well as the funding rate that the Australian government can get on any additional borrowing. So from that perspective, again, credit rating agencies have been, as I said, very comfortable in the way the government has been able to land in regards to the deficit at this point in time. Now, certainly, we don't believe that they can continue to run and continue to grow the deficit. Ultimately, it does need to be addressed. But certainly, as we look over the next couple of years, we think it's entirely appropriate that the government, as I said, does run a deficit and plan as the economic activity starts to improve and the economic growth outlook starts to improve, plan then to rein in that deficit. But as we sit here today, we think, as I said, it's certainly appropriate. Then you've got the ability of the central banks, which have also continued to be very active in this space. And the third chart here is just showing both the RBA as well as the US Federal Reserve and the expansion that we've seen in their balance sheets over the course of 2020, which has been quite significant. And the RBA has certainly been very active in that space. So when we think about both the fiscal spend that we've seen through the budget and the ongoing work that we've seen in that space, along with what we're seeing both in central banks, as I said, expansion of balance sheets, reduction of cash rates and the like, we continue to believe that it'll be generally positive for financial market performance through the back end of this year and into 2021 as the recovery starts to take hold. There's no doubt we're going to be operating in a very different economic as well as investment market environment in a post-COVID landscape. But from our perspective, we continue to believe that there are significant opportunities. And as I said, the budget that we've just seen handed down, in our view, does provide for those opportunities to be reflected in financial market performance. In the broad context, we continue to remain overweight equities relative to bonds in our portfolios, but we continue to believe that bonds have an important role to play, particularly during periods of higher equity market volatility that is most likely going to continue, as I said, as we head into the back end of this year and throughout 2021. As always, if you have any queries about your portfolios, please feel free to reach out to any one of our advisors. Thanks, and we'll catch up again soon. Bye for now.